Welcome to the Free from Wall Street podcast, where we share how we have done over $200 million in real estate deals to create, preserve, and pass on generational wealth without the roller coaster ride of the stock market. If you're ready to start investing with purpose, visit freefromwallstreet.com. But for now, let's dive into this episode. What's up, Wall Street naysayers? No, I'm just kidding. So today we're going to be talking about what's the best way to grow and invest $1 million. So if you're not a fan of math, maybe just skip this one because we're going to be running through some math on how to place our money to get it to the best type of returns that we can. This is part of why we invest in these deals, right? Why we invest in our fund and the real estate syndications. But what's the best way to grow $1 million, right? We like to use $1 million, by the way, because it's nice round numbers. But we're also aware that a lot of Americans are living paycheck to paycheck. They wish that they had a little bit more money in their bank balance. What happens if they come into some? What happens if you come into an inheritance, get a signing bonus, or you just come into some cash, right? So we want to explore 5 ways that you could grow $1 million over the next 5 years and which is the most profitable. So disclaimer time. I am not your financial advisor. I'm not a registered financial advisor at all. Every investment has risk. Don't take these hypotheticals as financial advice, but use it as a precursor to go and do your own research to find out what is the best for you and your family. So look, $1 million is a lot of cash. Instead of spending it, you're going to be smart. You're going to invest it into something instead of just spending it right away on Lambos and houses and the nonsense, right? That social media tells you is cool. It's not cool. Now I like the idea of active income. We like to work. I think we were put on this earth to work. I also like the idea of passive income so that it frees your brain up to work in a different manner than I have to go pay my bills, right? So that's why I think passive income is cool. I think active income is cool because it's what you were created to do. I also believe you can be more creative in your active income when you have passive income that's going to pay your bills. You don't have to worry about getting your bills paid, right? So let's talk about 5 ways you can earn some money over the next 5 years with your newfound $1 million. 1, savings account. Basic savings account. A lot of people do this. It's the default, it's the go-to. Check your mail this week. I'm sure you have something in the mail from a bank saying, come start a money market, come start a CD, come start a savings account, right? Because they want to pay you some interest. No, that's not true. They want you to put your money in there and be fooled by the idea of getting paid a bunch of interest. I'm just looking at what the current savings APRs are right now. So the best one that I found, right, and if you go to Bankrate.com, they typically tell you the best featured offers, 0.6%. with a minimum balance of $2,500. That is the best one I can see. Most of these are 0.5%, and those are still the online rated ones. The actual, drive-by Citibanks and Chases are more like 0.4. So anyway, savings accounts generally considered safe. They do earn some interest, but at 0.4%, you are not going to make a lot of cash on $1 million. You're going to be making 1.004, right, over that 5-year period of time. So savings accounts, number 1. Number 2, CDs. You can get CDs at a little bit higher of a yield, right? You can find out what those CD rates are as of today. I'm looking this up as we're going along, right? Probably should have been prepared for this podcast. But let's just talk about CD rates, certificates of deposit. It's typically a little bit more than your savings account can yield, but they might also offer less flexibility in how fast you can take your capital back out, right? They might have minimums. 1, 2, 3, 4, 5 years, whatever. So here we go. 1% is the best one I have found. It's Capital One, and that's today, right? So we're talking December 7th, 2021. So, all right, so you double your rate of return. That's pretty cool, right? If you can double your rate of return in most of your investments, you'd say you were doing pretty good. So over 5 years, that $1 million would grow to add 50K to it, right? So you'd have $1,050,000. So it's better, right? The other one, you're having like a little bit less than that, $1,025,000, making $5,000 a year. Now you're making $10,000 a year. Boom. Still not great. It's better, but still not great. So stocks. And now we're getting into like serious investment. What do we do with our cash? Why do I want to invest? Where do I invest it? Stock market, right? Wall Street. Well, you know what we're going to say about this one. All right, so there's higher rates, for sure. There's higher risk. Stock market can be volatile. Just taking a look at what happened in the market in the last week. Look at this. It's up 526 points today, right? In the last month, it has gone down as much as 700 points and up as much as 500 points. We're in a pretty rocky time right now with volatility. And you guys have known, I've talked about the story, my dad losing about half of his retirement funds in the stock market crash of 7 and 8, and then he passed away about 8 years ago, so he didn't get to ride this market back up to the highest it's been in the last, ever, maybe. So investments in the stock market typically will range about 7 to 10%, depending on a bunch of different factors, right? So let's give them the benefit of the doubt. Let's call it 10%, right? You'll have about $1.5 million after 5 years. What I don't like about that calculation, though, is it doesn't take into account volatility, right? So if the market falls 10% in one day, or if let's say you take $1 million and you lose 10% of it, you don't have to make 10% to get it back to where you needed it to be. You need to make 15% to get it back to where you needed it to be. So anyway, volatility calculators are very helpful when you're talking about this stuff. You can just Google volatility calculator to give you some good information. So anyway, the S&P, I think over the last 50 years has averaged 8%. So $1 million, you make $80,000 a year times 5 years, you made $400,000, so $1.4 million. Now we're talking, but there's some risk, right? Number 4, rental properties. This is what we thought we were going to do before we got into syndications, and it was because real estate, we know, appreciates over time. We'll get some cash flow in the meantime. We like it. So $1 million can go really far in the rental property space. You could buy a real estate property by putting $25,000 down. You could buy a $200,000 single family residence for $50K, right? Meaning put $50 down, buy a $200,000 property. And you could buy 20 properties wherever you want, right? And then let's say after your taxes and your mortgage and your expenses, that property brought in $300 in cash flow every single month. That's great news. That means after 20 properties, you got $6,000 a month or $72,000 a year that you'd be making in what they call active investor type income. And I call it active because you got 20 properties, you got 20 tenants, you got 20 toilets, you got 20 roofs, you got 20 HVAC systems. So somebody's going to get the phone call, whether it's you or somebody you hire. This does not account into what it would cost to hire somebody. This is just if you were managing it, $72,000 a year. At this rate, in 5 years, you have like $1.36 million, right? Pretty solid. And it's against a solid asset. Be a lot less volatility. Maybe some tenants will move in, maybe some tenants will move out. But it's not the stock market, right? So you have more stable, I think, cash flow. And then finally, we have to talk about some improvements, right? So if you have that $300 a month in cash flow, and then in year 1 or 2 or 3, your HVAC system craps out on you, then maybe you have a $2,000 or $3,000 repair that eats up all of that cash flow. But c'est la vie, these are rentals. Finally, you have your real estate syndications. This is the one that we've been talking about forever. This is why you tune into this channel, I think. And this is basically investing passively in large real estate deals. So a syndication simply means many hands make light work. We're going to come together. We're going to pool a bunch of investors together. We're all going to put our money together, and we're going to go buy instead of a 20 single family rental, or instead of a 50 unit property, we just bought a 384 unit property. We're going to buy a 987 bed student housing complex. So all these different types of projects that are way bigger than what you would be able to do on your own. So investing passively relieves you of the landlord responsibility, right? You don't have to manage the rental property. We have third-party property managers that we manage for that. It allows you to earn cash flow without having to find the individual properties that match your price point and your investment parameters and things like that. Minimum syndication investments, typically $100,000. You can invest more than that, right? So let's say you do let's say you just do $250K into 4 different deals, right? With a 6% average rate of return, right? So $1 million, 6%, making $60K a year over 5 years, you made your $30K, right? Or $300,000, sorry. So that annual return puts you in the ballpark of probably some of the more stable, non-volatile investments, or gives you the same type of return as the volatile investments, but being less volatile. And then it doesn't stop there, right? That's just cash flow distributions through the life of the deal. So you're at $1.36 million. Now you have another almost 30% or so, maybe more, maybe less, coming at the end when you sell these properties, right? So you've turned your $1 million into 1.6. You don't have to deal with tenants, toilets, volatility, things like that. As much volatility again. So you're talking about, when we talk about looking at these, it's equity multiple, right? So if we look in 5 years, what did $1 million turn into? If it turned into 1.3, you have a 1.3 times equity multiple, right? So this would be a 1.6 or 7 time equity multiple. Now that you thoroughly explored what to do with your $1 million, go put your money on the field to make more money. When you do come into that kind of cash, you know that you have a bunch of different ways to make cash, but hopefully this is helpful in determining how to figure out those rates of return. Now, finally, real estate syndication, what we didn't touch about on there, and I'm not an accountant, so I will disclaimer myself to death, but we have a lot of podcasts on here, coupled with accountants, talking about the tax benefits of syndication. What we didn't talk about was in year 5, after you cash out of all of these things, how much tax do you owe on each one of those? Well, some will vary from 0 to 40%, depending on a variety of factors. So that will also make a huge dent in how the deal continues to grow over time and compound for you and your family. So anyway, if you have questions about this, make sure you're reaching out to us. Go to integrityhg.com, sign up for the Investor Club, hit the Contact Us button, ask us any questions, get on the phone. We're happy to let you know what we've learned over the last, combined 30 years doing real estate and buying over $200 million of real estate in the last 3 years through syndication. So always happy to chat. Hope this is helpful. If you guys are enjoying it, please subscribe, share it with a friend, post it on social media, or don't. I would appreciate it if you did. All right, guys. See ya. Thanks for listening to the Free from Wall Street podcast. If you like what you hear, leave us a rating and review and let us know what you think.